Today, on this episode of Fly the Flag with Team AFN, we welcome industry mega expert Barry Habib and AFN's COO Jon Gwin. Hosted by AJ Berfumo. Let's listen in.
Hello, everyone, and welcome to the Team AFN Fly the Flag podcast. We have an unbelievable show here for you today. We, of course, are going to be joined by our COO, Jon Gwin, and Barry Habib, the founder of MBS Highway and a three-time Crystal Ball winner. So awesome. Barry is the only winner to have won this very amazing prize twice, and he has won it 3 of the last 5 years. So we're so happy to have Barry here today and talk about all the support that we get from MBS Highway to AFN. So guys, welcome to the Fly the Flag podcast.
Thanks, AJ.
AJ,
thanks for coming on, Barry. We really appreciate it.
Oh, I love you guys. You guys are family to me. And I don't have a flag behind me, so I feel a little bit bad. I am very patriotic, but at least I'm wearing the right color scheme. So I'm trying to get there.
Yeah.
So guys, let's jump right into this here. So of course, we're going to have some of our Team AFN members joining us and those out there that want to learn more about Team AFN and all we have to offer. So Barry, of course, I don't know if there's a better source out there on thoughts on the future of the real estate market. What are you seeing out there right now, Barry? What are some of your thoughts?
Well, we're all seeing how hot it is. We have to remember so many people are poo-pooing it for years. And one of the reasons why we have been accurate in this area is because we look very carefully at a lot of things that others don't. And one of the big ones for us has always been demographics. We look at birth rates. You guys know this because you've seen me talk about this for years. It's how we correctly forecasted the housing bubble, and it's also how we forecasted the housing boom correctly. And now it's so funny. I just saw an article where they discovered it in housing 15 years after we've been talking about it. So now they're discovering how powerful demographics are. Guys, this is a really powerful source. And the median age of a first-time homebuyer is 33 years old. So if you want to see when today's first-time homebuyer was born, they were born sometime between 1987 and 88. But when you look at the birth rates from 1989, that's next year's median age first-time homebuyer, and 1990, 1991, 1992, it goes up like a staircase in a very, very big jump. So we're about to see this enormous influx of first-time homebuyers, and there is also pent-up demand. Households should be formed at an even higher rate, but because of COVID, because of job situation, there has been the biggest one, lack of inventory. There are people that really want to purchase a home, but they're almost kind of being held back and restrained now. We all know how difficult it is. So when you say, what does the future look like? The demand far outweighs the supply currently, but it's going to be even more exacerbated and pronounced due to this pent-up demand, as well as the coming of age of so many first-time homebuyers. The reason first-time homebuyers is so big is because a move-up buyer, while they purchase a home and deplete inventory, they sell a home and they put one back. Right. So that causes more transactions, but it doesn't cause more inventory. The first-time homebuyer makes a real big difference because they deplete inventory without the replacement of one. Mm-hmm. So you call builders, and builders are not keeping up. They haven't kept up for a long time, and it doesn't appear that that situation is going to change. So housing will continue to see very big gains in appreciation over the next several years, but it comes with a lot of challenges for us.
Yeah, very interesting. So Barry, as you said, go ahead, Jon, please.
I was just saying, Barry, do you think anything with the forbearance market and the lack of inventory, do you think when forbearances open up and foreclosures open the market back up, let's say next year, do you think that will help or hurt the first-time homebuyer market with more inventory?
Well, so there's a lot of thoughts on this and forbearance. So, as I mentioned earlier, Jonathan, we've got a lot of challenges, right? We've got buyers that today are discouraged. Now, there's ways to improve that, and we can use tools that can really help that. So I want to talk about discouraged buyers in a minute. I also want to talk about the fact that When you look at 60% of transactions today, there are bidding wars, and over 40% are bidding wars above asking price. So these are two big sources of heartburn for real estate agents, for mortgage professionals. And then of course, there are the other considerations of, now do the mechanics change on LTV if you're bidding over asking price, because maybe the appraisal doesn't come in at that. You may win the home at that, but if you need a mortgage and it's above what you're going to get the appraisal, it causes issues. So one of the things that people try to do, and many things that people try and do that don't understand the housing market, that just want to say, oh, prices went up, so it's going to be a crash. Oh, this is like a bubble. It's not a bubble. First of all, there's no inventory out there. Just to put this in perspective, guys, in 2007, when we were saying, hey, there's a bubble out there, there was 3.7 million homes for sale. Today, there is 1.03 million homes for sale and decreasing. So almost 3 million fewer homes for sale. Inventory has dropped by about 70%. That's
wow,
crazy. So where you had 10 homes for sale 13 years ago, 14 years ago, you have 3 homes for sale. That's like the analogy there. But here's the other thing. Households. Back in 2007, there was about 116 million households. So all the people in the US lived in 116 million households. Today, it's 128 million. So we've gone up 12 million households, but we have almost 3 million fewer homes for sale. This is why we're experiencing that. So this sets up the question on forbearance that you had with the shortage of inventory. So the shortage of inventory, and one other thing I do want to make sure we cover is affordability, but the shortage of inventory is critical because as people talk about the forbearance issue, they're blowing it out of proportion. Just like people blew out of proportion, oh, adjustable rates. Remember that whole scare? Oh, you've got all these regions adjusting, market's going to crash. Never happened. We said it was not going to happen. So let's break it down real quickly. First of all, with forbearances, small percentage of people that go into it. When they come out of forbearance, what did you do? You put your payments on pause. So the paused payments now get rolled into what looks like kind of a promissory note or looks like a second mortgage, but there's no payments and no interest. So does it have to get satisfied? Yes. When? When you sell your home, when you refinance your home, or when you pay off your loan. So it's going to be very staggered. And it should not cause a lot of heartburn there because there's so much equity that it'll just be absorbed by the equity, tremendous equity gains that people have received in the past year. It should more than cover the amount of money that was put in forbearance. Not a problem there. But what about when you have to resume payments? Pause button comes off, you have to start making payments. Okay. So many people went into forbearance that could have made the payments, but they just chose to game the system.
Right.
No problem there. Most of the people got their jobs back. They were qualified before, they're qualified today, they're making more money today. No problem there. What about those poor individuals that did not get their jobs back? And there are quite a few of those individuals, unfortunately, right now. COVID affected renters by a ratio of 4 to 1 versus homeowners. So while there is still some, it's a very minute amount. So what do they do? The good news is they have a lot of equity. So their first thought will be, I got to preserve and protect this equity. How do you protect it? Well, maybe there are ways that you can temporarily, until you get your job back, tap into, if you have some savings, great. Maybe you borrow some money. Whatever it is, people will try and do that. Worst case scenario, they'll sell their home. And when they do, it comes on the market, sells in 5 days, if it lasts that long,
right?
They make a tremendous
over ask price.
But here's the thing. What does that excess inventory do? It's such a small amount. It's like a few droplets of rain in the desert. It will not do anything. Prices are going to continue to move up, up, up. So the forbearance issue, while we want to be sensitive to those poor individuals that can't resume their payments, of course, we have a heart. But if we look at it strictly from a business, does this impact real estate values adversely? Unequivocally, it will not. And those that are looking at this and crying wolf, or saying the sky is falling, just don't understand it. It's that simple. They just don't get it. They look at headlines and they don't look deep and they don't research and they don't understand.
Very enlightening. Yeah.
That makes sense. Yeah.
Now, with regards to affordability, which is the other cry wolf thing that we've always heard,
right?
This is the 7th most affordable market in history. And because it's the 7th most affordable market in history, people say, how is that possible? Prices are going up, even rates went up. Well, that's because if you take a look at where we were a year ago, let's just say somebody had $1,000 a month payment, he and I, their income would have to be about $5,000 a month, roughly, for that. Okay. So now they didn't buy the home last year because they listened to all these bozos on TV say, oh, the housing market's bad, or all the articles we've seen are, oh, housing, blah, blah, blah. They didn't buy. So this year they want to buy, but home prices have gone up 10%. So price went up 10%. So their payments, since rates are roughly the same, they're actually an eighth cheaper now than they were a year ago, but let's call it the same. Payment went from $1,000 a month up to $1,100 a month.
Right.
So it went up $100 a month. You'd say, well, maybe it's unaffordable, but their income went up. Now, here's where people make a mistake. They look at hourly earnings, it went up 4%. No, weekly earnings you look at, because you can make more or less hours work for you. Weekly earnings are up 7%. So their income, if it went up 7%, they're making an extra $350 a month, more than compensates them for the $100. This home, even though it went up 10%, it's actually more affordable this year than it was last year. People just don't get it because they don't do the math. And now discouraged buyers, because they can't find something, use the cost of waiting tool. You guys have that. You have access to it in MBS Highway. Realtors are losing their mind. And the other tool that's on fire right now is because more than half of the transactions are bidding wars over asking price. And when you take a look at that, when you take out cash deals, when you take a look at that, that bid over ask tool is beautiful because it uses our AVM. And what it does, it will tell you, hey, this home, if somebody wants to go $40,000 over asking price, is it a good decision? Well, what we want to answer for that customer is if it takes only 3 months or 4 months until the value of the home eclipses the amount you're bidding over asking price, you should do it.
Right.
We understand that LTV, appraisal issues could come into play. I'm not being insensitive, but from just strictly that standpoint, it's a good business decision if you can make it work. And then we show them how much the home's going to be worth 4 or 5 years from now. So it really gives them an incentive to move forward, because we know for each zip code what the appraised value forecast is. We're the only ones who do that. Now, when we take a look at that, this is a super powerful tool. Realtors are going crazy. This is the answer to their prayers. Guys, you have the gold. All you have to do is use it. I know everybody's been busy, but it's time to reintroduce yourself to what you need in this market, and you've got to win. Look, to rely on, oh, we're going to win a pricing war, that's a very bad strategy. To rely on, oh, I'll get your loan done more expediently. I mean, come on, have you not heard of Moore's Law? Do you not see technological advances? Do we really think we're going to be doing mortgages the same way 3 years down the road? You want to be in business 3 years down the road. You want to protect your family. So what you need to do is you need to make the biggest investment that you can in your most important asset, and that's your brain. And then the tools that you have are your words. That's simple, but nobody does it. I should say nobody. So if you do it, and that's to your advantage, because you've got a great company, great leadership, great tools. You just have to put in the work, and I know you can, to educate yourself, to bring yourself up to that next level so that you put yourself in a position where you're head and shoulders above your competition. Look, when it was busy, crazy, everybody, anybody could do right.
Right.
This is what, it's great that things are different now because it gives you a chance to shine. And I hate when people say, well, it was a great ride while no, still great. This is even better. Are you not using the debt consolidation tool? You'll do more refinances now using the debt consolidation tool and making more money at higher loan amounts than when everybody was throwing deals at you. Because what you're doing now is you're also gaining fulfillment because you're changing people's life and making them happier. The debt consolidation tool is a game changer. Somebody said they did 40 transactions last month on the one tool alone in March. 40 transactions, just debt consolidation. This tool is something that will change your life and your customers' life.
And just want to throw in there, Barry, everything that you're speaking about, all the tools that Barry's speaking about are available to all Team AFN members. Reach out to our awesome marketing team, Corey, Ashley, the rest of the team, always there for all Team AFN members. Please reach out, learn more about what we have available with MBS Highway.
Andrew, I want to give a shout out to Corey. They're amazing, just amazing. The whole AFN team is. My buddy Tony Casillas, the leadership, everybody's just great. I mean, so Corey gets a lot of love from me because she's amazing.
And we appreciate the partnership. We appreciate the tech forward, everything that you do on the tech side. We're a tech forward company. We appreciate everything that you provide us. We're an education forward company. We appreciate you partnering with us on CMA. We appreciate all of your wisdom, all of your daily updates. Everybody uses them on a daily basis. Now, in the market right now, do you see, besides consolidation, so let's say we have a consumer direct branch and they're switching to more debt consolidation model, retooling to sell that. We're also seeing a new type of formation that's coming into the marketplace, which is a transaction coordination company to really go after these first-time home buyers. And we've seen a number of these transaction coordination companies pop up across the country. These companies are tech forward. They want to partner with lead companies and partner with realtors and then provide the lead and then walk the borrowers through every aspect of a purchase, which allows a consumer direct loan officer to also do purchases. Have you seen anything new pop up on that realm?
Yeah, you nailed it. People are looking to purchase leads, and then the key is to convert those leads, right? So, so your discussion with that customer has to be super engaging. You have to show them and articulate with facts, not just oh, it's air. Your words have to be backed up with really sound reasoning as to why this process, which is not easy for anyone to purchase a home today, you have to like win the home. So means you may have to spend more than you thought. You may have to stay in the game longer than you thought. It's not easy shopping for homes. You're going to sacrifice time, but we have to show them the rewards as to why this work is so important that they're doing. And all those tools are critical, whether it's the real estate report card or buy versus rent or the appreciation reports or the bid over ask, as I mentioned earlier. Why these things matter so much, or the cost of waiting. This builds a whole profile and picture. And listen, here's the other thing too. I want to touch on rates really quickly before our time runs out. And that is rates are going up. Now, you heard me say this at the end of last year when we told everybody, look, in 2021, rates are going to go up, but then they're going to taper back down later in the year. Masks come off. People think that that's when rates go up. No, that's when you alleviate the supply chain. Look, have you noticed your wait times for Uber are longer? Have you noticed your prices for Uber are longer? That's the epitome of what's going on with supply chain. You have people that are getting money from the government, fine, so they're not coming out to work. So there's fewer drivers, longer wait times, higher prices. It's the same thing with people now waiting for the masks to come off to really come back to work. As that starts to happen, you alleviate the supply chain. As the stimulus begins to wane, you alleviate the supply chain. You have more workers coming in, less pricing pressure, less inflation. Inflation drives interest rates. Speaking of inflation, here's the warning. Right now, the consumer price index core rate that strips out food and energy, this is an important one, is 1.3%. You have mortgage rates, I don't know, roughly 3.25%, roughly, right in that ballpark, right? So that's the metrics there currently. Now, mortgage rates have gone up a little bit because people are assuming that the CPI is going to go up. We're going to get some inflationary pressure. So mortgage rates have gone from roughly 2.75% to 3%. So they've seen about 0.5% already priced in. Here's what's going to happen. Next week, we're going to get the consumer price index number for March of 2021. It's going to replace March of 2020. So you take the new March, you replace last year's March. It's going to make the consumer price index go from 1.3 to 1.5. No big deal. But be on the lookout for this, and mark my words, here's what's going to happen. When you get April's number, which we get in the second week of May, CPI is going up to over 2%. When we get May's number, we get that the second week of June, it'll be at 2.5%. There is no way that lenders are going to give you a rate of 3.25% on a mortgage with inflation at 2.5%. It's not going to happen. Now, I said about 0.5% baked in. We got about another 0.5% to go. So you mark my words, end of spring, early summer, mortgage rates in the range of 3 5/8 to 3 7/8. We may touch 4%. What's your strategy as a professional? Your strategy has to be this. Client, stop being butthurt. Stop saying, hey, I really wanted the rate under 3. Okay, stop that. I see so much of this stupidity.
That's true.
3. Hey, so I could have saved you $300 a month. Now I could save you $250. Is saving that a bad deal? Even if you're right and rates come back down, but it takes a year to get there, you could have been saving $3,000. That incremental $50 a month would take you 5 years to break even. Okay, is that a smart move for you to do? Of course not. Start saving the money today. Take the emotion out of it. Stop with the I got to be under 3 and show people our rates are going up. It also means that it might be worth it for you to bid a little bit more today because you're just going to want to bidding more later. Even if you don't believe prices are going to go up, which they are, rates are going to go up. So bidding a little bit more today at the lower rate is better than even if you got the price you wanted at a higher rate. That's what you have to warn people to do. A couple of other last points. Towards the end of the year, I see inflation tapering back down. Rates should ease a little bit. But there's a recession coming. I don't know if it's 22 or 2023. Remember when I told everybody there's a recession coming? Nobody believed me. There is a recession coming. We do all this stimulus, it wears off. Last year's stimulus was $2.8 trillion. It was done in the spring. By October, it wore off. This year, we've got between December and March's stimulus, another $2.8 trillion. We follow the same playbook. Towards the end of the year, it should wear off, and you will start to see a big slowdown. Rates will ease, but we should be headed towards a recession, and that will push rates. So the loans you're doing today above 3%, You are planting the seeds for tomorrow's refinance. And just like in 2019, I told all of you, think about this when you're doing your loans. You're going to be refinancing these people, so you don't want to be paying points. You don't want to be paying upfront MI, pay monthly MI, and don't look for the lowest rate. Take a little higher rate and take lower fees, because you won't reach that 5-year recoupment break-even period that you need when you take a lower rate and higher fees. So please think about these things, and you will be in a really good refinance market, I believe, in a not too distant future.
I think, Barry, from what I've picked up from in the last few minutes here, which is very interesting, is your statistics from very early in our conversation about the 33-year-olds born in 87, 88, 89. They're now coming up. Inventory's down. We're going to have more home buyers, but also a recession is coming. So it's going to be very interesting to see how that all balances out.
Yeah, you're going to have lower rates. You're going to have high home demand, and prices will continue to rise. Prices are going to get, I mean, look, goodness knows, the further out you go, the foggier your forecasts become.
Right.
But I can tell you this, it is very clear to me that short-term rates are going to go up, prices on houses are going to go up.
Mm-hmm.
Medium-term rates will ease a little bit, prices are going to go up. If you go out 2 years, 3 years, there is so much demand coming that real estate values have to go up. And people say, well, wait a minute, doesn't it become less affordable? We just did the affordability. Look at California for a minute. And I know, you got your home base there in California. People say for years, it's too expensive in California. But what do prices keep doing? They keep going up. Why? Here's the reason why that nobody seems to understand. The homeownership rate in the United States right now is about 67%.
Mm-hmm.
In California, it's about 50%. That's how it compensates. You see, there are enough people that can qualify to purchase a home. You have more than enough people. So when the US prices keep going up, maybe your homeownership rate drops from 67 to 60, but home values will keep, you have the amount of humans that will buy a home overwhelms the cost and price. They can afford it.
Right.
You don't need to have a 70% homeownership rate. As California has proven, you can have a 50% homeownership rate. So if you lose people be able to buy homes, there will still be enough people that will push that demand with such tight supply to see home values continue to rise, at least for the next 3 or 4 years.
Right.
Yeah, and we're on the same page with you. We're prepping for that same prediction. We're interim, keeping our consumer direct branches retooling, bringing them back in a few years as we see rates. You can't spend and borrow this much money and not see rates dip. It's not possible. So we appreciate everything.
Debt slows economic activity.
Yeah.
Economic activity slow down, pressures inflation lower, as well as technology, lower inflation, lower rates.
No, I fully agree. And I just want to plug that book behind you. I appreciate you. I appreciate Money in the Streets. Many sayings in there that I use with my kids, and continue to teach them beyond just the mortgage industry, but some very wise words in there. So
Brother,
thanks for that.
It was so meaningful to me when after you read the book, you reached out to me. It was really meaningful to me. So thank you so much for that.
Yeah, no, it was great. And I appreciate it. We appreciate the partnership. I give you virtual hugs right now. And
AFN family.
Virtual hugs all around. Team AFN.
Yeah.
AFN, baby.
We
Go,
really
baby.
Appreciate it. I'll turn it back over to AJ to close us out.
Yeah, guys, I mean, this half hour really quick here. Barry, thank you so much for all the enlightenment that you brought today. Jon, thanks so much for being here. Once again, Barry, as Jon said, and we can't say enough here at AFN, thank you for all the support. As we said, go Team AFN, and thank you so much for everyone for listening to the Team AFN Fly the Flag podcast.
May I give a quick shout out to my dear friend who I love, Matt Schultz, and God bless him and his new baby. So I just wanted to make sure I said that.
Yeah.
What a beautiful family. I'm proud of him and Jon. I just want to give them a shout out.
That is the best dressed baby at AFN.
Oh,
Absolutely.
yeah, baby. Yeah.
Yeah, absolutely. Big shout out to Matt and Jon and all they do for Team AFN each and every day. And yeah, that kid's got a bright future.
Unbelievable.
Yeah.
He's got the right genetics, that's for sure.
He comes from good stock.
That's for sure.
All right. So once again, thank you so much, Barry. Thank you, Jon. And thank you for listening to the Team AFN Fly the Flag podcast.